Right. Welcome to the MSL Business School. MSL here. We are looking at IAS 36 on impairment of assets. This question should help anyone preparing for a corporate reporting paper, a financial reporting paper, or any strategic business reporting. Anything financial reporting, accounting, corporate reporting that tests international financial reporting standards, this should be of a lot of help to you. Those preparing for CIMA exams, diploma in IFRS for ACCA, you should find this helpful. First degree, master's programs. Once you're studying IAS 36, this should be of help to you, right? So our requirement is quite simple. Explain how the transaction described above would be accounted for in the financial statement of MSL PLC. We are looking at the impairment of a single asset. The next time we could look at something called cash generating unit, CGUs, right? But for now, let's focus on the impairment of a single asset. Are we good? All right. So what is our requirement here? MSL PLC has a single substantial asset called the USIC tech, which it uses to manufacture computer chips. The carrying amount of the USIC tech after 4 years is 5 million. So this is accounting carrying amount, right? So it has a cost of 7 million and accumulated depreciation on a straight line basis of 2 million, right? So this would pretty much be the IAS 16 property, plant, and equipment value under the cost model, right? There is no expected residual value, so we don't expect to have any scrap value or value at the end of the useful life. Due to a breakthrough in technology in the manufacture of computer chips, so this is an indicator of impairment, right? We have internal indicators and external indicators, right? So due to a new tech out there, the company now believes or they expect the machine to produce 30% less than expected over the rest of its estimated useful life in the next 10 years, right? The net future cash flows for the next 5 years, based on management's best estimate, after taking the 30% cut into account, are as follows. So we expect to make 600,000 in year one, 660,000 in year two. All figures are in thousands, by the way, right? 710,000 in year three, 755,000 in year four, and 790,000 in year five. Then beyond year five, the expected growth rates for the following years are in year six, we expect to grow by 2% from the prior year. In year seven, we expect the cash flows to decline by 1% from the prior year. In the eighth year, we expect cash flows to fall by 7% from the prior year or the previous year. In year nine, we expect cash flows to decline by some 16%. And in the final year 10, we expect cash flows to fall by some 30%. If the machine was sold now, it would realize some 3.2 million Ghana cedis net of selling costs, right? So this is the information we have. And at the bottom, we are told here that the discount rate to be applied to the future cash flows is 10%. Then we have the relevant discount factors here. So our present value factors are 10% from year one through to year 10, right? So this is the information we have been provided, right? Okay, so before we start this, we need to look at a quick recap of IAS 36. What is this standard about? As the name implies, it deals with the impairment of your non-current assets, right? So we need to look at this carefully, right? We'll come back to the question. So IAS 36, high level, right, deals with impairment of assets. You could have mainly two causative factors, right? You have your external factors or indicators of impairment and your internal factors or indicators of what impairment, right? So for the external factors, a few could be, there could be a decrease in the market value of the asset because of passage of time. There could be adverse changes in the market or business, the tech environment, economic legal environment, increase in the market interest rates, which will affect the discount rates to be used, right? So many of these things, or let's say the carrying amount of the entity's assets would exceed the market capitalization, pretty much for mainly listed entities, right? These are external indicators. They are signs your asset could be impaired, right? Internal factors could be things like if there are changes in the method of use of the asset, if there's physical damage or obsolescence, right? If you realize that management has the plans to reorganize the entity, or if you find out the economic performance of the asset is now worse than expected. There are so many others, but these are just some indicators. When you see these factors, you should try to test for impairment, right? So an asset is said to be impaired. So this is the impairment test, your impairment test. So an asset is said to be impaired if the asset's carrying amount, right, is greater than the asset's recoverable amount. At the very basic level, this is what IAS 36 has to say. When you're testing for impairment, once your carrying amount exceeds your recoverable amount, the asset is said to be impaired. Carrying amount is what we know under the relevant standard. So for example, under IAS 16, your carrying amount under the cost model will be the cost less any accumulated depreciation, less any accumulated impairment losses, right? That's an example. So under the recoverable amount, what does the standard have to say? The recoverable amount can be defined as the higher of two things. So this is the higher of, higher, not lower, right? Higher. It means the greater. The higher of two things. The higher of, the first is the asset, what? Value in use. Value in use, right? So that's the first thing we consider. Then your asset fair value less cost of disposal, right? The asset's fair value less, some will say cost to sell, right? Fair value less cost of disposal or less cost to sell, which is basically how much you can get the asset or you can derive from the asset in terms of fair value after deducting all possible selling costs, right? Okay, so that is your fair value less cost to sell or less cost of disposal. Your value in use is basically the discounted present value of all future cash flows that you expect to make from what your continuing use and eventual sale of the asset. So if your carrying amount is greater than your recoverable amount, which we've said is the higher of the value in use and your fair value less cost of disposal, then the asset is said to be impaired. Are we good? So when your asset is impaired, we have something called an impairment loss. This impairment loss must be charged as what? An expense, but where it will go to depends, right? If you have an impairment expense or an impairment loss, this, like I said, is an expense. So it reduces the value of the asset, right? And the corresponding debits will hit loss. But it depends. If you have impairment for a revalued asset, then please make sure the impairment loss should be charged to the revaluation surplus. And only if you have any excess should that go to profit or loss. So take note, for a previously revalued asset, you should first check if there is a revaluation surplus standing to the credit of the revaluation surplus account, then you reduce first to the revaluation surplus and the excess will go to profit or loss. Apart from that, the default is to take your impairment loss to profit or loss straight away. Are we good? All right. This is the process for testing a single asset. We have another type of impairment test we'll conduct for cash generating units, but that is not the focus of this. So let's come back to the question. If we've said this, right, let's look at the elements we have in this question and let's try and do justice to this, right? So we've been told that for this particular asset, we have a lot of information. At least if you look at the question critically, we have been given what? The carrying amount of the asset. So we've been told clearly, without any doubt in our minds, that the carrying amount of the asset is 5 million. This is the carrying amount, right? Okay. So looking at our requirement, right, we want to talk about how this will be accounted for. Are we good? All right. So given the fact that we have the carrying amount of 5 million, what is the fair value less cost of disposal or less cost to sell? That is also given us here at 3.2 million. So let's indicate this here. So in this question, we have our carrying amount, which is what? 5 million. Our fair value less costs to sell or less cost of disposal would give us a figure of 3.2 million. So looking at the explanation here, we are missing out on this guy here called value in use, right? So we need to determine the asset's value in use. That is the missing piece of the puzzle. So we need to find our value in use figure, right? Okay, how do we determine value in use? I said for value in use is going to be the present value of all your future cash flows, discounted obviously, right? We need to do that. All the information given us here was so we could find this. So you can see here we have the year, the cash flows, and some growth rates. So we have 10 years worth of data. We need to set up our table to do that job. So let's do this. So let's set up a table this way, right? Hopefully you can see the question on the left. So we have our year. We need 10 of this, right? We have our growth rate, our growth rate. We have our future cash flow, future cash flow. We have our present value factor at 10%, and this will give us our discounted cash flows, right? So this is the information we have. And let's do some justice to this. Don't forget that all figures are in thousands of Ghana cedi. So 1,000 and 1,000. Okay, so we have 10 years here. So year 1, year 2, 3, 4, 5, 6, 7, 8, 9, and 10. Right. Okay. So based on the question we have, let's list our cash flows. So year 1, from what I see on the left-hand side of the screen, year 1 is 600 in terms of the future cash flow. So 600, right? Year 2, I have 660 all in thousands. Year 3, 710. Year 4, 755. Year 5, I have 790. It's 9. Year 6, I'm not given the rate. So this will have to bring the growth rate. So I'm told that year 6, if you look at the question carefully here, we are given specific data on the growth rate. So from year 6 to 10, what you have will be growth rate. So growing by 2%, falling by 1% in that order. Let's list our growth rates here clearly. Are we good? All right. So for year 6, we need to put here, we expect to grow by 2%, so plus 2%. In year 7, we expect to fall by 1%, so minus 1%. Year 8, we expect to fall by 7%, so minus 7%. Year 9, we expect to fall by minus 16%. And year 10 will fall by 30%. So what we are going to do is to grow or reduce our cash flows based on these estimates we have here. Are we good? So for this, what we have to do is a very simple relation. If you want to grow a figure, right? So the amount times 1 plus the rate. This is if you want to grow. So this for growth. For decline, it will be the amount times 1 minus the rate. This will give you for what? a decline. So that's what we're going to apply here. That's all really. So let's do it for year 5. So for year 5 to year 6, we are saying the year 5 estimate will grow by 2%. So this is going to be pretty much 790 times what? 1 plus 0.02. We are growing by 2%, right? Okay, so let's take our calculators. Let me do that on my end. So 790 times 1 plus 0.02. That gives me 805.8. Let's round to the nearest. So this will give me 806. For the avoidance of doubt, I did 790 times 1 plus 2%, growing by 2%. Do you get? So you grow this previous year by this growth rate to get this figure here. All right. So let's continue. We'll do same for year 7. Year 7, you take the year 6 figure now and reduce it by 1%. And like I said, if it's a reduction, you are going to use this relation, the amount times 1 minus the rate this time, right? Okay. So this will basically be what? 806 times 1 minus 1% is 0.101, and that should work. So I'll have 806 times what? 1 minus 0.01, and that gives me 797.94. Like I said, we are rounding to the nearest, so this should give me 798. So the method continues. We take the 798, reduce it by 7% to get for year 8. Okay, so this will be 798 times what? 1 minus 0.07 to find the reduced amount. So this gives me 798 times 1 minus 0.07, 742.14. So rounding off, 742. Are we good? We do for year 9 as well. Year 9, we're going to decline by 16%. So it's going to be the same 742 times 1 minus 0.16, right? So that gives us 742 times 1 minus 0.16, right? And that gives me 623.28. Rounding off will be 623. And finally, I do for the 10th year, I'm going to decline this by 30% or reduce by 30%. So 623 times 1 minus 0.3, and that should be my figure, right? So 623 times 1 minus 0.3 gives me 436.1. Rounding off will be 436. 436, right? So at the end of the day, we found all the cash flows. We need to now put the discount factors here, and then we should be able to what? Find the discounted cash flow. So if you look here, the question also gives us the discount factors at 10%, because the question says the rate is 10% for discounting. So what we're going to do here is just copy and paste these numbers, right, into the table that we have. So we just lift them and bring them here. So let me do that here. I can see here, year 1 is 0.90909, right? Let me move this a little bit here. All right, 0.90909, right? Okay, year 2, what is given in the question is 0.82645. Year 3, 0.75131. Year 4, what we are given is 0.68301. Year 5, I'm given 0.62092. Be careful when you get here. so you don't do an error of transposition, right? Because the numbers could change. Year 6, we have 0.56, 447. For year 7, we have 0.51316, 0.51316. For year 8, we have 0.46651. For year 9, we have 0.42410. And the final year 10, we have 0.38554. All we now need to do is to multiply the future cash flow by the discount factor to get the present value. What is really happening here is, let me show you. In time value of money analysis, right? Your present value basically equals your future value divided by 1 plus your rates to the power n. This can be written as your future value times 1 over 1 plus r to the power n. So technically, the discount factor is this component that we have here. That is your discount factor. That's what really is happening at the back end, right? So we need to remember this. So let's multiply the cash flows by the discount factors. So the first one would be, we'll do 600 by this, 660 by that, 710 by this, in that order, right? For all 10 years. And when we are done, we'll sum everything together. So the first one, 600 times 0.90909 should give me 545.45. We can just round off to 545. So this is 545. Second year, 660 times 0.82645 will give me 545.45, roughly 545, right? So 545. Year 3, the same thing. This times that, right? That is what we are doing for all 10 years. So 710 times 0.75131 should give me 533.43, or we can put 533 here. Then this times this, that'll be 755 times 0.68301 should give me 515.67. That 515.6, we can round down to what? 516. Year 5, 790 times 0.62092. That should give me what? 490.5. That can be rounded to 491. Then year 6 will be this times this as usual. So 806 times 0.56447 will give me 454.9. That can be 455 rounded. Year 7, 798 times 0.51316 should give me 409.5 roughly, right? So that can be written 798 times 0.51316. Yeah, 409.5. That can be written as what? 410 roughly, right? Okay. The next one is this times that. So we have 742 times 0.46651. That should give me 346.1. That would be 346. Year 9, as usual, this times this. So 623 times 0.42410 should give me 264.2. So that is 264. Then the final one, 436 times this, will give me 436 times 0.38554, should give us 168.0. So that is 168. When you have this, you need to sum all the discounted present values, and that will give you your value in use, right? So we're going to sum this for all 10 years, all of them, right? So let's do the math. So year 1 is 545 plus year 2, 545 plus year 3, 533 plus year 4, 516 plus year 5 is 491. Year 6, 455 plus 410 plus 346 plus 264 plus 168, right? I got 4. Let me change this. I got 4273. This is your value in use. 4273. 4273. Right. So this is our value in use. So remember, if you discount your future cash flows to present value, that gives you your value in use. So back to this. Let me copy this to the bottom. So if we have our carrying amount of 5 million, fair value less cost to sell of 3.2, we have determined our value in use. So our value in use as computed, we got what? 4.273, right? So this is 4.273 million. If you recall, we said your carrying amount will be compared to the recoverable amount, right? And your recoverable amount, as you can see here, recoverable amount is the higher of your value in use and your fair value less cost of disposal. What is the higher of the two? So our value in use is 4.273 million. Fair value less cost to sell is 3.2 million. Clearly, this is the higher. So we can conclude that our recoverable amount equals our value in use, which is the higher, which equals 4.273 million. Then we can say carrying amount, our carrying amount of 5 million is greater than our recoverable amount of 4.273 million. Therefore, the asset is impaired. The impairment loss will be the difference. So our impairment loss should be the difference between 5 million and 4.273 million. So when you do the math, what does this give me? 5 minus 4.273, right? 4.273, right? Since this is in thousands, remember that. So I got 0.727 million. This can be written, if you want it in thousands, clearly it is roughly 727,000, right? This is your impairment loss. Your impairment loss, and this will be charged as an expense in the statement of profit or loss and other comprehensive income. So this goes to your P&L, right? It goes to profit or loss as an expense, right? P&L expense for the year. On the statement of financial position, the asset will now be recorded at the amount of 4.273. So the new carrying amount on the statement of financial position will be 4.273 million because we wrote down the asset from the carrying amount of 5 million to the lower amount of 4.27, right? So the double entry really is we debit profit or loss with the impairment expense and we credit the asset with the impairment loss to reduce it to the carrying amount, right? So that has been it for this particular question, right? You can take a look at this, go through the question, and that will be it, right? So this is our basic example on IAS 36 on impairment of assets, until we come your way again with something else on international financial reporting standards. That will be it for today. If you love this video, give us a like, subscribe to our channel, and share this video with those in your network. Enjoy the rest of your day. Bye for now.